Welcome to the Florida Divorce Podcast, your source for the information you need to successfully get through your divorce and into the next exciting chapter of life. Now, here's your host, Attorney Scott Kalish.
Hey everybody, this is Attorney Scott Kalish. I am a divorce and family law attorney in South Florida. Today I have a pretty special episode. I actually have two guests. First time on the podcast, I think that I've had two guests. I got forensic accountant Jason Soman. How's it going, Jason?
It's going well. I'm also an amateur podcast producer, so we're here in my office in Boca Raton.
Appreciate you hosting this episode. It's awesome. And then I'm also accompanied by Don Moll, mortgage specialist, divorce mortgage specialist.
That's
Thanks
right.
for having you, Don.
Well, thanks for having me. This is my first. I've never worn headphones before.
Really?
Yeah.
No, but you have your own podcast, right?
No, I've on my website,
Gotcha.
but I've never done, I was invited to one podcast before.
This is your first podcast?
Like
I'm
this.
honored.
Yeah.
I'm honored.
Not
I think I was your first guest too, right? Jason, on your podcast?
Absolutely, yeah.
Yeah.
And I think I was your first guest also.
I think, yeah, you absolutely were. Yeah.
So there's a bunch of firsts on this episode.
Yeah,
So that means I've got to invite you guys to if I ever do one.
You got to do one. I feel like you have a ton of information to, to give the people. And that's part of the reason why I wanted to have you on today, to understand and really to, convey to the listeners exactly like what your role is in divorce. Can you kind of introduce yourself and tell us a little bit about yourself and what you do?
Sure. So this will be my shameless narcissistic moment.
No, I mean, the whole episode is. So that's why I have you on. Please.
So my name's Don Moll. I'm what's called a certified divorce lending professional, or the acronym CDLP for short. And what that means is I'm a independent mortgage banker who just happens to focus my practice on working with divorcing homeowners and as a member of the professional divorce team, including obviously the divorce attorney and forensic accountant. So what my role is in the whole process is, especially when the marital home is front and center on the marital balance sheet, is oftentimes we'll have one spouse that wants to retain the marital home. The other spouse will be vacating and purchasing a home of their own. Mm-hmm. So my role is to really help navigate the many different nuances, and there are, because the journey of the divorcing homeowner is much different when they actually purchase the marital home.
Sure.
So the whole process is not only different, but working with the likes of you, Scott, where the documents that you submit to your family judge have to align with the documents that, as a lender, that I submit to my judge, the underwriter. And oftentimes, without that knowledge and the input of a CDLP, the ability of your client to effectuate, say, maybe the equity buyout of the marital home is impossible just due to the language that is in your marital settlement agreement that doesn't coincide with the mortgage application.
Gotcha. You mentioned a little bit before that, getting possibly a refinance done during a divorce is a lot different than getting it done when you initially, actually buy the house. Can you walk us through a couple of the differences?
Sure. So you recently went through a mortgage, or I know you and your sister, someone just went through a mortgage process, right?
Yeah.
So you've been through it before.
Of course.
So I'm going to take a leap and say that process was something like this, where your mortgage professional said, Scott, I'm going to need a couple years of W-2s, a couple years of tax returns. Yep. I'm going to need to take a look at a couple months of your financial statements. I'm going to need a month's worth of pay statements. Mm-hmm. I'm going to pull your credit. Mm-hmm. Based on that, I'm going to tell you what you can afford in terms of purchasing a home for yourself. Mm-hmm. Something like that.
Mm-hmm. Yeah.
So that process, when it comes to the divorcing homeowner, is we really break it into 4 different stages. First, we've got to vet the marital house itself.
Okay.
Details of the house are going to be vital.
Okay.
To what type of financing is available or not available to the spouse looking to retain the marital home. We take a look at factors such as valuation. How do we come up with that valuation? Was it an appraisal that was done? Was it what's called a comparative market analysis, or a CMA that a realtor will do?
Okay.
There can be some potential gaps in those. We want to make sure that we narrow those gaps so there's no gaps in that case file. We want to take a look at what kind of equity are we dealing with. And then, so once we find out the necessary details of the home, then we move on to income.
Okay.
Because many times, say if we're dealing with a spouse that's been the primary caregiver and the other spouse has been out earning the wages, there will be support income, whether it's alimony, whether it's child support, maintenance payments, etc. So there are certain guidelines that we have to adhere to for that income. After the Tax Cuts and Jobs Act of 2016, any settlement agreement signed on or after January 19 is, there's no longer a tax incentive for the payor. So if the financial assets are there, the resources, many times we're seeing, okay, in lieu of monthly alimony, here's a lump sum for the equalization payment. Okay, great. You've got that spouse now has a large fat bank account,
Sure.
but no income.
Sure.
Or maybe that spouse is now reentering the workforce after an absence.
Mm-hmm.
Okay, there are certain guidelines that we have to meet before we can even count that new employment income as what's called qualifying income.
Gotcha.
So from there, then we have to look at the debt.
Yeah.
Many times we've got marital debt, how that debt's going to be assigned, how it's going to be distributed.
Yeah.
Has a huge impact on both spouses when it comes to obtaining mortgage financing. And then once we know those three aspects, then we can move into, here are different potential mortgage solutions that are going to fit your need. So that's how that process kind of broken down easily, how it's different than when they actually went and purchased the home.
Sure. Can you talk a little bit about, give us a feel for how, alimony and child support payments work into someone's, income and having that used as, overall income to qualify for a new mortgage?
Sure. So I'll answer it this way. First of all, when we think income, one of the most frustrating aspects for my clients to understand is the difference between income and what's considered qualifying income.
Okay.
Qualifying income is an underwriting term, because what happens is a spouse that I'm working with will say, well, I know what my monthly cash flow is, but Don, you just chunked it down and it's a lot less than what
you actually receive. Yeah.
Right. Which is understandable. Mm-hmm. So when it comes to support income, there are guidelines, and there's different agencies. You've got Fannie Mae, you've got Freddie Mac, you've got FHA, you've got USDA, VA, and each of the agencies has their own guidelines when it comes to support income.
Mm-hmm.
But the general rule of thumb is, if we are working with a spouse that wants to retain the marital home and is going to be using support income, and for our listener, support income, it doesn't matter whether it's child support or alimony, there are what we consider consistency and stability guidelines that we have to meet for that support income. So what that means by that is the underwriter is going to say, okay, if you want me to use this support income as qualifying income, I want to make sure that the payor of this, say, alimony,
sure,
makes those payments as ordered. So let's just say, for example, if alimony is $1,000 a month that's going to be due on the 5th of the month, and the payor says, well, I'll pay $500 on the 5th, and then I'll pay $500 on the 15th when I get paid again, that's not going to pass the stability and consistency test. So they have to be paid as ordered. And then what the underwriter is going to say is, if we're going to be doing what's called a conventional loan, the underwriter is going to say, well, I want to see the payor make 6 months of payments as ordered before that looks like qualifying income to me. So we have to wait 6 months for those payments to be paid as ordered before we can even start the mortgage process.
Wow.
And then once the underwriter says, okay, I can see that the payor has made 6 months of payments as ordered. Now I want to see those payments are going to continue for an additional 36 months. So in essence, we need a minimum of 42 months of payments.
Gotcha.
So where we'll run into issues is, we'll say, sometimes a marital settlement agreement will say, okay, the spouse retaining the home has 180 days to retain or to refinance the home. Say, well, if we're using support income as qualifying income, it's just not going to work. So that's where the value of having a CDLP come in and say, okay, listen, let's just make sure that we structure the settlement agreement and the real property section in a way that your client can successfully effectuate this part of the equity buyout.
Yeah, that makes a lot of sense, and it's very, very important information to have at the front end, because if you don't have it, you're pretty much set up to fail.
Well, that's when I kind of prefaced before.
Yeah.
The documents you submit to your judge have to align with the documents that we submit to our judge and underwriter.
So if someone is thinking that they want to keep the house, right, and do a refinance, when do you think the best time to contact someone like yourself or yourself? The
earlier the better. I just had someone call, because people are going to our website now. I just had someone call earlier this year, and he said, I just got divorced. And I said, does this mean we have a final judgment? He said, yes. I said, okay. He said, and during the divorce process, my wife said that she wanted to sell the home. So now she's changed her mind and she wants to keep the marital home. But I'm on the mortgage. So she wants to assume the mortgage, which is a whole nother issue. So as it turned out, had there been one sentence of language in the settlement agreement, it would not have been an issue for him. He was looking to purchase a new home. And I said, okay, you're going to have to go back and either, whether it's an addendum or an amendment to the settlement agreement. Otherwise, so that's now delaying his ability to obtain mortgage financing for purchase.
What was that one line that had to go into the
So
settlement agreement?
What's happening now, and it kind of leads to a big topic right now, and that's loan assumption. Because Fortune magazine last month had a statistic that 99% of mortgages have rates that are lower than the rate environment that we're in today. So back during the pandemic, rates were at historic lows. They're in the 2s and the 3s. Now we're in the high 6s. So what's happening is people refinanced during the pandemic. They're down in the 2s or the low 3s. And now they're saying we're getting divorced. And one spouse says, well, what if I went to refinance, I'm going from 2 something to 6 something.
Yeah.
Can I just assume the loan? And there's 2 types of loan assumptions. There's what's called a simple assumption and there's what's called a qualified assumption. The simple assumption is one spouse, let's say she's retaining it, he's vacated, and it's his mortgage, or they're co-borrowers. In either case, she can just make those payments so she can be assigned that debt to be making those mortgage payments. Now, in this case I'm talking about, all we needed to see, so what'll happen in that case?
Yeah.
Maybe he says, okay, I'm comfortable with you making those payments, because it is a big ask, because if she's not timely with the payments,
Oh, yeah.
he's still obligated.
He's still on the hook,
right?
and it's going to be his credit that's going to
His
be
credit's going to take a huge hit. Or if she defaults, then he's still on it. However, if there's language that you would put that she is now going to be responsible for making the mortgage payments, as long as it's in the settlement agreement, in this case, what would happen is when he goes and talks to the lender, the underwriter is going to say, okay, I fully recognize that he's still obligated to this mortgage. However, that is now considered what we call a court-ordered assignment of debt or a contingent liability. Therefore, the underwriter will remove that monthly mortgage obligation from his debt-to-income ratio. So from a qualification standpoint for him obtaining new mortgage financing, it's not going to impact him negatively.
Gotcha.
But I always, in fact, I was in a mediation this morning, and this couple, very amicable, and I said, if she assumes it, just so you know, it's a big ask because your credit can take a hit.
There's got to be a lot of trust there still.
Right. Absolutely.
But at the end of the day, they can go out and buy a new house, and that new property is not going to affect, or no, the old property is not going to affect their credit and their debt to income ratio for the new property, right?
Correct.
Do I understand that
So
right?
that's why when this gentleman called me, I said, we're just missing that one sentence.
And it's possible to go back as a lawyer, it's possible to go back to, amend and do an addendum to the marital settlement agreement and possibly even get, an updated final judgment. But you're saying that for your role, that's enough.
Had that team brought in a CDLP to advise, then it would have been a non-issue.
Gotcha.
Now it's just more work involved.
Is there one mortgage company that you work for, or can you get mortgages for or through multiple different companies? How does that work?
Right. So I'm the mortgage lender. So I'm an independent mortgage bank.
Okay.
So you've got commercial banks and you've got independent mortgage banks. Okay. We're an independent mortgage bank, which means all we do is mortgages. A mortgage broker will be one that represents different mortgage banks. So the difference between the two is, as a lender, we actually have the in-house underwriting. We fund the loan, underwrite the loan, and like 90+% of the banks, we sell the loan.
Okay. And then in terms of getting your advice or getting your, input or getting you on board on a case, how does that work? How much does it cost?
Oh, sure. Big concern with clients because they're already retained to death, right?
Yeah. So. The attorney, accountant, and then now another mortgage professional expert, right?
So as a licensed loan officer, I am bound by the Equal Credit Opportunity Act. So I am prohibited from charging a fee for what I do. So I'm just like any other mortgage professional, then that when the loan closes, our respective bank pays us. So that's why I always tell the clients that I work with is, hey, listen, you're not going to be paying me out of pocket.
No money out of pocket.
But if you're going to be refinancing the home or maybe purchasing a new one, I just ask that you consider me to help you with that transaction.
That sounds like a win-win.
Yeah. So, and I'm a consumer too, because they write in my business, what's your rate? What's your rate?
Yeah.
I'm like, look, I'm going to tell you what every bank up and down Main Street is charging. By the way, we all get it from the same place, and that's Wall Street.
Gotcha.
So
competitive rates.
If we weren't competitive, we wouldn't be in business.
Right.
Yeah.
Makes sense.
Right.
Okay. So if the listeners want to get in touch with you to get your input or advice, how can they do that?
Couple of ways. I've got a website that's pretty easy to remember. It's thedivorcemortgageguide.com.
Nice.
So if they go to thedivorcemortgageguide.com, that's an easy way to, and I would encourage them, if they're going through a divorce, every month, the Divorce Lending Association, we come out with a monthly newsletter, and there's a lot of great information
Sure.
each month, and they can go in there and check out the library, and they'll see a little 2-minute video of me, and all my information's there.
Okay. Nice.
So.
Well, I appreciate you coming on to the podcast.
This is great.
Giving everyone this really important information. Thank you also, Jason, for hosting us again.
Jason, you got to quiet down next time, man.
Yeah, no. Jason, do you have any questions for
No,
Don?
I definitely have some questions. I was just holding them in. I didn't want to.
All right, go ahead. Sorry, I almost ended the podcast.
And when you're talking about qualifying income, Don, I know a lot of times when we're determining someone's income during divorce, it includes like personal expenses and things like that. Like, are those things that you could consider in qualifying income? Or let's say they own a business and they get a car paid for, or they get use of the corporate credit card, private jets, things of that nature. Are those, I guess, what would be included in qualifying income?
Sure.
Or certain things that may not be included that someone would want to.
Right. Well, if they've got the corporate jet, a lot of those people don't need a mortgage. But,
There you go.
but
Thanks for pointing that out.
However, so in terms of qualifying income, no, it's a fair question, because what'll happen, especially self-employed, right? And so they'll bring their 1099s and their tax that's been prepared by the tax preparer. Well, the tax preparer's job is to minimize,
Sure.
right, their overall income, factoring in expenses, right,
right,
for tax purposes, to minimize their tax liability. Then they go to apply for
a mortgage.
And the underwriter's saying, well, where's the income, right? So there, you got a disconnect.
Uh-huh.
But in terms of income, Jason, it goes all back to the IRS. What's been reported to the IRS?
Really?
Yeah. So people will say, well, you know, I had a divorcing couple, and she has a rental home, and she's got a renter in there paying her, I think, $2,000 a month, but it hasn't been reported. So even though she's receiving $2,000 a month,
Wow.
we can't use it
Because,
because it hasn't been
not on the
reported.
taxes.
So it's whatever's on the taxes. I don't know if that answered your question.
Yeah, I think so, because I think a lot of times when we determine someone's income, it's very different than what was reported.
Oh, it's very different from an exact opposite of what, you require, right? If we had to rely on taxes, I mean, a ton of people aren't, forthcoming on their taxes. So
Right.
it would cut a lot of people short,
Just like financial affidavits, right?
Exactly.
They're very accurate from
That's
that.
the biggest joke, and it's such a shame. It really is, because it's such an important document that you're swearing under oath, under penalties of perjury, that, hey, this document is legitimate. And I've never seen an honest financial affidavit ever.
No, I was brought in a case, and the other spouse asked if I could qualify him based on the financial affidavit that he filed.
Oh my God. That's so
just,
funny.
Well, you don't know, but yeah. So, that's believe me, Jason, that's the biggest challenge when it comes to creating that qualifying income. So
awesome. Well, appreciate you coming on the podcast again. Thanks again, Jason, for hosting, and maybe we'll do this again.
Oh, this is awesome.
Appreciate it.
Thanks for having me.
Thanks for listening to the Florida Divorce Podcast. To learn the 10 secrets behind every successful divorce, visit floridadivorcepodcast.com. If you'd like Scott's help in your divorce case, go to kjlawfla.com.